Charlie Munger has just sold off half of his Alibaba shareholdings, which is in stark contrast to his accumulation of over 600,000 shares over the past year or so. What exactly does this mean for us shareholders in Alibaba? That's what I'm going to dive into in this video. So smash that like button, subscribe if you're new. You're watching More Money. Let's get it. Well, the day has come, guys. Everyone who said that they're going to stick with Charlie Munger into the investment in Alibaba now has to reconsider their investment, as Charlie Munger just sold off 50% of his shareholdings. Am I there yet? I don't think so, but let's dive into this news report. So it was reported today that Charlie Munger sold half of his stake. And you can see here from this chart that I pulled off of Datarama, Charlie Munger reduced his Alibaba holdings by 50% at a reported price of $108 per share. So effectively, he sold 300,000 shares, which is, yes, half of his holdings. And so what exactly does that mean for his sort of Alibaba journey here? And that's what I'm going to show to you in this next chart here, where you can see that in Q1 of 2021, that's where he started accumulating shares. He took 165,000 shares at an average share price of $226 per share. And I know a lot of you guys have an average purchase price which is much lower than that. And then moving on, in Q3, he effectively doubled that by getting up to 302,000 shares. And then he once again doubled that position, again getting up to 602,000 shares. And that second double was at $118 per share. So how does that really look? How can we make sense of that? So if you look here at this chart that I produced, you can see that his average purchase price was $226 per share at the end of Q1 of 2021. Then in Q3 of 2021, his average purchase price declined to $191 per share. And that's because he was buying up another round of shares at $148 per share. And then in Q4, you can see with his subsequent double down at the share price of $118 per share, his average share price once again declined to $155 per share. But as you can imagine, by selling his shares at $108 per share, he's still losing money here. And so you can see here from his average purchase price, he's down $46 per share, or an effective total loss of approximately $14 million. Now, there's really two ways that you can look at this. One, you can look at it from the perspective of he's trimmed his holdings and he's taken a loss from the average share price. The other way you can look at it is that he purchased 300,000 shares at approximately $118 per share, and now he sold them at $108 per share. So he really only lost $118 per share minus that $108 per share, so $10 per share times the $300,000 shares. So effectively he lost $3 million, not that $14 million number that I previously quoted. And that also effectively puts his average purchase price back to $191 per share. As an investor, that's how I would personally look at my own portfolio. I just reversed a subsequent purchase, but you can look at it either way. So overall, effectively what I'm saying is that it might not be as bad as one originally thought, but here's my real question. If you believed in it at over $200 per share and you were able to buy it at $108 per share, and then you sold it at even lower than that, what does that really mean for your belief in the company overall? And that's kind of my concern here. But also, I never really cared if Charlie Munger owned it anyways. I did all of my research on my own. And I want to show you guys something. I actually crushed my channel's number of subscribers and the growth that the channel is experiencing, because the last 7 out of 24 videos that I put out on this channel, going back a month, have actually been negative on China. And the reason why I did this, even though it doesn't help with the growth of the channel, it reduced the income of the channel, is because I really want to push out value and truth as opposed to just trying to make money. There's a lot of people that are just pursuing echo chambers on YouTube, and that's not what the point of this channel is. And hell, I'll do away with a growth in subscribers if it means that I can continue to focus on truth. And so what have I been saying? And really what I've been trying to do is do my best to highlight the risks in investing in China, and thus the risks of investing in Alibaba. Now, I am still an owner of Alibaba. I don't have any intentions of selling my position, but you do have to highlight the big risks that are happening currently in the environment. Now, the first risk that I want to mention is that you can see that companies continue to exit manufacturing in China. So, of course, less investment in China is going to mean a troubled environment for the locals in terms of generating job growth. And like has been previously mentioned, China is targeting approximately 11 million new jobs in their economy this year. Well, how are they going to do that if manufacturing continues to leave the country? And it was just reported even today that Apple has now started to build their iPhone 13s in India as opposed to China as a way to diversify any potential risks or sanctions that could happen between China and the US. So they're essentially proofing their economy by diversifying where their manufacturing facilities are, which is bad news for China. The other area where I'm seeing a lot of risk is this continued zero COVID lockdown policies. It's starting to really impact China. You can see that people are reporting on social media that it's becoming chaotic. And once again, that's going to weaken the Chinese consumer more so than it already has if they continue to pursue this policy. I just don't think they have any other choice. And so you can see here, their unemployment rate is starting to tick up. Their latest unemployment rate figures are the highest they have been in over a year. And so you can see here that Beijing has set to target the creation of over 11 million new urban jobs this year after adding almost 13 million in 2021. But how exactly are they going to do that if they continue to lock down their consumers? They're continuing to have this real estate situation, which is causing more people to become unemployed, and companies are leaving the country. Now, the other item that I have mentioned on this channel before is China's labor force participation rate. Look, the labor force participation rate globally is declining. There's no qualms about that. But you can see here that the labor force participation rate continues its mass decline in 2021 at least. And of course, you can rely on that 2020 figure because a lot of manufacturing in China did pick up by the end of the year. But yes, so once again, China's continuing its trend of its labor force participation rate declining. And why is this? Well, the country is aging. Like I've mentioned previously on this channel and on the Alibaba 5 or 6 part series that I put out initially last summer, the country's population is expected to start declining this decade. And the one area that I was hoping to see addressed during the 2022 National People's Congress was the further initiation of a property tax to address their housing issue, but that didn't happen. You can see here that the Chinese government failed to approve a property tax. In Xi's eyes, the real estate market is the epitome of China's unsustainable growth model. It supports nearly 25% of China's GDP, a rate higher than both Spain and Ireland before the Eurozone crisis. A typical apartment in Beijing now costs 25 times the annual wage. Thus, high housing prices add to a tremendous burden on Chinese people and suppress their consumption and innovation power. And I don't think there's any easy way to get around this. You're going to have to eventually initiate that property tax to address the problems that I pointed out in the 4-part series that I put out on this channel on China's real estate crisis. Look, I didn't have to put out videos highlighting issues in China. I could have just continued to push the echo chamber and I'd get huge views. I was getting like 20,000 views a video when I was pushing out positive news on China, but I didn't really want to do that. I really want to focus on the truth. It is absolutely okay to be positive a company, but then also point out the negative aspects of that company. And that's really what I try to do on this channel. And going back to that whole positive aspect, you can see here that with the companies list that I'm following, which I make available to the Patreons, Alibaba is still the cheapest company with respect to the share price as a percentage of its intrinsic value. Also, Alibaba has no debt. Their model is such that it is inflation resistant, not downturn resistant. Don't conflate the two. And its intrinsic value is expected to be realized by both growth of EPS and the revaluation of their EPS, so i.e. that EPS multiple. And so it's still a fantastic opportunity. However, Alibaba is not the only opportunity available in the market right now. You can see just on this chart alone, there's 5 other companies that are trading at less than half of their intrinsic value, and 3 of them have low to no debt. They're somewhat inflation resistant, and their intrinsic value is expected to be realized through a combination of growth and revaluation of that multiple. So there's lots of opportunities. And like I've been saying on this channel previously, I've been buying more stock over the last couple of weeks than I have over the last couple of years. So that's kind of what I'm seeing in terms of the overall market opportunity. And I've always stressed diversification, and this is why. Although I don't believe that it's time to exit the Alibaba investment just yet, I still believe that the company will do fine over the long term. I think a lot of people are going to start reevaluating their position. And here's one of those situations where it would have really benefited to not get so deep into Alibaba. Throughout all of 2021, I was just building a cash position. I think in 2022, I started the year at around 70% cash, and now I'm at around, I think, 50 or 40% cash. So in order for you guys to get access to those models, I make it really cheap, only $5 a month. I'm not trying to make a significant amount of money here. So for $5 a month, you can get access to all those models. The summary sheet ties to a model that supports each of the valuations in the most granular details possible. And you can see from the Alibaba model how much in granular detail I get to. And with that being said, I really want to stress I am seeing a big opportunity with US housing companies, and you can get to that video right here.